The recent wave of decline caught the market off guard. As prices pulled back, noise on social media increased, emotional commentary intensified, and a short-term panic atmosphere formed. That's why in this video, we'll focus not on emotion, but on data. Our only question is this: realistically, how far could Bitcoin retrace? One, the big picture. Where is the trend? From a technical standpoint, the picture is clear. Price is currently below the 200-day moving average. This average is one of the most fundamental indicators used to measure long-term direction. We are also below the realized price, which reflects the cost basis of short-term holders. Historically, when these two metrics break down simultaneously, the market usually remains weak for a while longer. This does not mean price will collapse vertically. However, statistically, momentum tends to remain to the downside. 2. What does the volume profile say? Looking at the areas where Bitcoin previously saw the highest trading activity, the $57,000 to $72,000 range stands out. These zones represent areas where buyers and sellers interacted most intensely. Price often gravitates toward high liquidity regions and finds balance there. For this reason, rather than an aggressive and sustained collapse, spending time within this range appears more likely. 3. Statistical extremes. The Z-score model. There are models that measure how stretched price is relative to its own historical behavior. With the recent decline, a historically rare downside deviation has formed. The -3 sigma level of this model corresponds to roughly $60,000. In previous cycles, price did not remain sustainably below this level. What does this mean? Further downside is not impossible, but a prolonged collapse is statistically low probability based on historical data. For the logarithmic risk model heat map style risk models that measure whether Bitcoin is expensive or cheap show that we have entered a low-risk zone. At the end of January, the risk level was around 31%. Following the recent decline, it dropped to approximately 18%. Historically, bottom regions have typically formed within the 3 to 5% risk range. Theoretically, this corresponds to the $48,000 to $50,000 price band. So, is the $50,000 level statistically possible? Yes, it aligns with historical data. 5. On-chain perspective. Supply and profit. Currently, approximately 55% of the total Bitcoin supply is in profit. 45% is at a loss. At previous bear market bottoms, this ratio typically ranged between 40 to 50%. Mapping this ratio to price suggests more moderate scenario, $53,000 to $60,000, more severe scenario, $47,000 to $53,000. What's notable is this: independent models are pointing to very similar zones. That's usually not coincidence, it's data alignment. 6. The macro front. Gold and monetary policy. Recently, gold has shown strong performance. Historically, safe haven assets move first, while risk assets react with a delay. Changes in central bank reserve preferences and fluctuations in the dollar suggest that liquidity conditions in the system are shifting. When money starts to become cheaper, the first reaction is towards safe assets. Later, capital rotates into risk assets. This cycle has repeated several times in the past. 7. Conclusion. Technical data suggests we are approaching a bottoming zone. On-chain data points to a historical bottom range. Risk models indicate increasing long-term asymmetry. This does not mean a rally starts tomorrow. Bottom formations usually take time, feel boring, and move sideways. However, history shows us this. Cheap money plus low-risk zones plus periods when investors are underwater often form the foundation for the next major move. Maybe not immediately, but this is usually how the process begins.